Nike is a well-known company and despite its size is expected to grow profits very fast in the coming years. But what is Nike all about? Do they offer juicy dividends? How much have their sales and profits grown in the past? Are they on sale right now? And important for companies in the clothing and footwear industry, how do their margins compare? You will learn about this and much more in this video on Nike. Nike grew by over 40% in share price in 2020, outperforming the S&P 500 despite a challenging environment due to store closures. Nike is another one of those iconic brands that everyone knows about. Nike is the largest seller of athletic footwear and apparel in the world and has large influential sports players connected to their brand. I remember when I was a child, you were a cool kid if you were wearing Nike shoes. My girlfriend is an absolute fan as well and has like 10 different pairs of special editions. Nike offers products in 6 categories: running, Nike basketball, the Jordan brand, football, soccer, and training and sportswear. Besides the name brands, they also own Converse, Hurley. Although Nike is known as a typical American brand, nowadays most of their revenue comes from outside the US. Most of the growth is also not coming from the US markets, but from markets such as Europe and Asia. But the fastest growing market is Greater China. Nike had a big run up in 2020 and gained about 42%, but it wasn't always like that. Just a few years ago, in 2017, the stock price was almost flat for 2 years, as it was losing market share to Adidas. So something had to change. And that is when Nike came up with the consumer direct offense strategy and the triple-double strategy. As part of the consumer direct offense strategy, they made shifts in production, distribution and marketing, and they laid off 2% of their workforce in 2017. They started to focus their growth efforts on 12 major cities in 10 countries that they deemed to be critical for growth. The triple-double plan was to double innovation, speed and direct connections with customers. And it worked. Nike grew revenue by 6 and 7.5% in 2018 and 2019. But the biggest component of their new strategy was to do more direct-to-consumer selling through their mobile apps, by partnering up closer with parties such as Foot Locker and Nordstrom, that were willing to create a different experience for customers, and they eliminated partnerships where they did not get much special attention, such as Amazon. Did it work? Oh yes, it did. In 2020, partly forced by the changed market circumstances, Nike was able to generate 35% through direct sales. The other 65% is sold to wholesalers, which obviously cuts into their margin. On top of that, they are also able to collect tons of data on their consumers' behavior through the Nike Plus running app. This helps Nike in having a deeper understanding of their customers' preferences and trends. To help predict the upcoming demand, they also acquired data analytics platform Select in 2019. Deeper connections with customers are also formed through the membership that Nike offers, which is free, but offers exclusive access to their Nike Live concept stores, faster shipping, and so on. They have over 100 million members already. Apparel and athletic sportswear is a competitive space though, and some of Nike's biggest competitors are Adidas, Lululemon, Under Armour, and VF Corporation. The CEO of Nike is John Donahoe, who has been on the board of Nike since 2014 and became the CEO in 2020. Likely one of the toughest years to become CEO. He's also chairman at PayPal. Let's look at some dividends. Does Nike offer juicy dividends? Nike has raised its dividends for 20 years now, so they are well on their way to become a dividend aristocrat. The dividends of Nike are also well covered at 37% earnings payout ratio and 44% free cash flow payout ratio. This also reflects in their perfect dividend safety score of 99. As a dividend growth investor, the yield of Nike is a bit on the low side for me, with a yield around 0.8% and a dividend growth rate of around 10 to 11%. With a yield that low, I prefer a bit higher dividend growth rates, such as the case with my recent purchase of Visa. Now that we know Nike has very safe dividends, how about their sales and profits? But first, a bit about this channel. I'm Tom from the Dividend Attitude Show. On this channel I make in-depth videos about dividend stocks, battles between 2 dividend stocks and portfolio updates on my personal portfolio. Nike has a very nice uptrending sales trend and an average growth rate of almost 9% per year, which is very nice for a big company such as Nike. Obviously 2020 was a tough year for them, with a decrease of 4% in sales. Most of the sales growth is coming from outside of the US though, with Greater China being the fastest grower in 2019 and 2020. Footwear was and is where the largest portion of the revenue is coming from for Nike. And looking at the type of customers, it is good to see that the consumer direct offense strategy is really paying off for Nike, because that sales channel grew near 10% in 2020 to about 45% of their total sales. One of the goals of the restructuring in 2017 was to increase the margins. So how did that work out? It is interesting to see that both the gross as well as the operating margin did not increase that much after 2017 and is around the 10-year historical average. I wonder why that is, so I will keep this question in mind and I will answer it at the end of this video. But operating margins are on the higher side compared to competitors such as Adidas, Under Armour and on par with VF Corporation. The only one with much higher margins is Lululemon. The profit or net income trend did look good until 2017, but then had a big dip in 2018 and Nike has actually not surpassed that high of 2017 yet. In 2020 for obvious reasons. Some more digging is needed here as well, so I'll write this one down as well to get back to that at the end of the video. Sufficient free cash flow is important and a good indicator to know how well the dividends are covered. As we can see here in the graph, the orange line, free cash flow, has always well covered the white line, the dividends. So that gives me a lot of confidence as an investor. Though great sales and good profits help to keep a company healthy, it is how that money is allocated that determines the health of the company and how safe the company is. In other words, we need to take a look at the balance sheet. To get a quick glance on that, I like to take a look at 3 ratios. The debt to equity ratio, the current and the quick ratio. The debt of Nike was very well managed until 2020 came along. Nike had quite a stable debt to equity ratio below 0.5. I can guess what happened in 2020, but let's write it down to get back to it at the end of the video. To understand if a company is able to pay off its short-term liabilities with its short-term assets, we take a look at the current ratio. Above 1 is preferred. Nike is and has been well above that at about 2.5. But not all short-term assets are created equal. So we look at the most liquid short-term assets, such as cash, compared to the short-term liabilities, also known as the quick ratio. For Nike, this is at 1.4, so above 1 as well. Next, we are going to look at the future prospects of Nike, and after that, if they are on sale or not. But first, how good is Nike at generating returns for the shareholders? For that, we can take a look at the return on equity and the return on invested capital. A return above 10 is preferred, and Nike has a very good return on equity of just below 30%, and a return on invested capital at 15%. A good credit rating helps companies to borrow cheap debt. Nike has a great credit rating of AA-. What about the future of Nike? What are the things we should keep an eye on and what kind of growth can we expect in the future? The short-term future of Nike is of course impacted by the illness. But the vaccine rollout gives Nike perspective for a greater future. In Greater China, where the virus is already better contained, Nike saw an increase of over 50% in revenue and the digital sales increased almost 60%. These are great numbers and they prove that Nike as a company has shown to be resilient in the current environment. And I think this will bode well for their future as they increase their digital footprint. The main challenges currently are in their supply chain due to the congestion in the ports and of course the store closures. Their latest quarterly results also showed an increase in gross margins, which is also a good sign for the future. What are the predictions of analysts on the future of Nike? 31 analysts on FastGraphs are expecting a 95% increase in earnings per share year over year, which of course is partly a recovery to prior levels, but it is still a hefty increase. And even beyond that, 2022 and 2023, analysts are expecting high double-digit growth of 26% in 2022 and 18% in 2023. Because those are high numbers, I decided to double check with the future predictions on Yahoo Finance, and they are in the same range. Also, what gives me confidence is that analysts have been within 10% of the actual profit predictions 9 out of the last 10 years, which tells me that analysts have a very good grasp on Nike. And now a very important question. Is Nike on sale or not? On FastGraphs we can see that the price line, black, is way above the orange, intrinsic value, and blue line, the historical valuation of the market, indicating overvaluation, meaning they don't seem to be on sale. If Nike would return to the orange line, it would have an annual return of minus 25% per year. And if it would return to the blue line, you would be looking at a negative 12% per year until 2023. I like to look at different valuation methods. So let's use the dividend yield theory, as Nike is a consistent dividend payer. The dividend yield pattern is showing a similar situation, where fair value would be around $104 and undervalue around $83 compared to the current price of $138. But we're not there yet. We have some unanswered questions that came up in our analysis. such as why did the margins not increase as they should have due to the triple-double strategy Nike announced in 2017? Why did the profits or net income drop so much in 2018, and why did the debt to equity skyrocket in 2020? First, the margins. In 2018, the margins were negatively impacted by an unfavorable exchange rate. In 2019, the margins increased because of growth in Nike Direct, higher selling prices and favorable exchange rate. Then, in 2020, the illness hit, which also negatively impacted the margins of Nike. So all in all, we can see that exchange rates have a big influence on the margins of Nike because they are a true global player. As a global player, Nike also took advantage of the Tax Act introduced in 2018. This caused the profits to go down by 54% that year, which explains the big dip. As for the uptick in the debt to equity ratio in 2020, caused by the increase in long-term debt, honestly it was very hard to find specifics about this in the end of year quarterly report or the annual report. The most I could find was a loan taken out to purchase the Japanese distribution center. I assume they also took on some debt to have more cash available to be sure. So it is quite safe to say that Nike is not on sale at this point in time, though I think it is a great company to invest in with bright future prospects. I personally don't like the risk-reward ratios at these prices. And as I said earlier, as a dividend growth investor, I would like to see higher dividend growth rates with such a low starting yield. If you like these company analysis videos, I have good news. If you click on the playlist in the top right, you will find many more company analysis videos. If you want a lighter format where I compare two companies in the same industry, be sure to check out the playlist in the bottom right. YouTube thinks you will like this video next. And I'm out. Until next time, bye bye.